has been tough. It's been uncertain times. Investors absolutely do not like uncertainty. War, post-pandemic, banking crisis, war, climate crisis, etc., etc. You all know that. And at Linz, the investors talked a lot about what has changed and what is the new reality for startup funding. So the news is not bad, not all bad out there. Many deals were done. And what I kept on hearing again and again is that good startups get funded. So the topic of today really is to really try to understand from our investors here what they have heard, what they are doing is their everyday job, tap into their minds and understand from our investors here, one from a VC, one from a corporate, and one from a private bank, not private bank, a banking advisor, what a good tech startup is and what has changed in 2023. So welcome, Ole, welcome, Fabian, and welcome, Cam. What I would like you to do is to introduce yourselves and tell us what you do. So please, everybody, mute your mic so that we can hear our panelists. And you can also put off your cameras unless you are speaking so that we can focus on our panelists. Can we start with you, Ole? Please tell us a little bit about what you do and so on.
Yeah, for sure. Thanks, first of all, for the invitation. Really nice to see you after we met in Linz. For me, it's always a little bit like a homecoming since Attractive, who co-hosted, is one of our portfolio companies. So I'm sometimes down there, even though it's not that easy to get there from all different locations across Europe. However, so I'm with Monkfish Equity, which is the vehicle of the Trivago founders. We are GP only, basically, meaning we don't have any external investors. It's only the capital of the Trivago founders that we're investing. That makes it a little bit special. We are not a classic or traditional VC fund. However, we are focusing on a lot of B2C topics, often platform and marketplaces. And in the invitation, it was already said, we actually have 3 PedTech related investments with Tractive that I already mentioned, and also Dogo and AlphaPet are in our portfolio. So I think with 3 investments in the PedTech space, we are already considered a specialist. I definitely don't consider myself that, but I'm happy to share a couple of few points with you. And maybe one last thing that has to be mentioned with Monkfish, we are focusing a little bit on later stages, so Series A, Series B, often as co-investors because we don't have a large team. And then we just recently started kind of a business angel network where we try to bring together the resources of our network to also start to invest again into earlier stage startups so that we can also facilitate our pre-seed and seed deal flow. That about me.
Would love to hear more about your business angel network later on if you've got time. Cam, welcome.
Hi, thanks for having me here. Lovely to see you again. For everyone on the call, just to introduce myself very briefly, I'm from Stifel, which is an investment bank, where we're a transatlantic investment bank focusing solely on the mid-market. So we look at earlier stage businesses up into those doing £1 billion IPOs or M&A. I sit as in the private capital markets business, so my role is really helping young businesses raise capital from Series B up until IPO, and I sit cross-sector, so pet tech sits across our sectors of consumer, health and technology, and I work very closely with the bankers there. We've got a few mandates that we're working on at the moment, so we're quite live in the market discussing with both the company side, investor side around this topic that we're going to spend some time on today. And it was great to be at Linz. I thought it was a fabulous event, just getting together all a network of people from different spaces, different types of pet technology, and it's great to see all the traction that's being achieved within the sector.
Amazing. Fabian, last but not least, my colleague.
Yeah. Thank you, Kim, and good afternoon to everyone. Thanks for having me today as well. Fabien Desirage, I'm the head of business development and ecosystem for Purina Europe. My mission with the team is how do we expand from a pet food nutrition company to a pet care company, which is nutrition and services. And my role is really to define where we're going to play in services, which verticals, but also execute the strategy in terms of being M&A, partnership, or build. Over the last 5 years, Purina has made several investments. Mostly, I would say, M&As in D2C, in services, but also strategic partnership on the vet side. So I can also elaborate a little bit on this during the call today. And thank you for being there with you.
Great. So maybe let's just dive into the state of the affairs, right? State of the current economy, 2023. It's pessimism all around, and you've said it yourselves, right? The things have changed. How is this current economy affecting your company? I've heard that cost of VC money has increased dramatically. People in the investment community want to take less risks. You have got different expectations. Perhaps you could just tell us if has anything changed with this current economy so that our startups can actually understand why you behave the way you do sometimes when they're talking to you. Fabian, would you like to start? I think from a corporate, it's quite clear.
Yeah, I think from the corporate, we all know that, and we discussed that in LIS. I think we are operating in a very attractive high growth category. This is the first thing. And this category is also recession resistant. And we've seen that. We have a couple of factors that we know, Gen Z and millennials getting into the category. The COVID has increased pet ownership, and all of that give, I would say, this high growth that is still there. Okay, when you look at how the category is growing, we still see that the category is growing fast. It's very clear that we are still impacted by the pandemic and the war in Ukraine when it comes to what we see in Purina. And the key element for us as a corporate is that we've really seen our margin under pressure. Okay, so this has been something that we had to live with due to the fact that we had inflations. So that's one element as a corporate that we see is that despite what is happening, we still see that the category is growing. And after I can come back, Kim, to what we do see when it comes to what extent it's affecting what we do. One thing I can say is that if I look since the start of the year, the number of deals that we receive now every week has increased drastically. So we really see that there is a change of era which has started. And I'm happy that after we discuss later, on what it means for us.
So profitability squeezes and then lots of more work because more companies are coming to you. So interesting. Cam, what about you guys? Has the economy affected how you guys work at Stifel?
I'd say in my role, there's across sector, because I spend most of my time speaking to investors and working with investors, bringing them to companies. Investors have generally become much more cautious on the types of businesses that they're looking at, and they've become more focused around the financial model that meets their requirements. So yes, there's additional deal flow of companies that need assistance to connect with those investors, but the investors are taking a more cautious approach. And so we need to be much more organized and coordinated on our end to bring the right companies to the right investors. And, the days of 2021 where deals were getting done within 4 weeks, that world has changed, but there is still, there's still active money looking for companies to invest in, and there's still good companies that are able to deliver those results. And this sector is one that's attractive because you have the high growth, you have customer base that is quite loyal, but the point is that investors are now looking to profitability, and they're looking to how are you as a company able to generate your profit in the near term while still growing in an inflationary environment, and how is that macro impact affecting you as a corporate?
So it sounds like the conversations have taken a little bit of a different turn when you're talking to your investors during this time. So we'll talk a little bit about how those conversations go. And Ole, what about you guys? Easy to raise money as a VC?
Well, we are not dependent on getting LPs, so that changes a lot. But I can actually start with or pick up on what Cam just mentioned. So much more focus on profitability. I mean, and also what Fabian was saying, you have the high inflation rates, but at the same time, I think that also led to higher interest rates that we're seeing, and that is kind of shifting the financial models for us as investors, and that is probably what Cam also related to, talking about the business models, the financial models, the profitability. Because of the higher interest rates, kind of like our valuation models that we try to build around investments that we're looking at, they dramatically change when there is higher interest rate. That means the cash flow in the far away future are not worth any longer that much, and that means we're much more focused on short-term cash flows or profitability and what kind of sense you want to measure it. I think that is kind of one of the major reasons why the investors are so much more focused on profitability. But I think there are even much more influences and arguments why we focus more on profitability. You also mentioned, Kim, the higher uncertainty because of all the major events that just occurred and happened, and we don't know really how the future looks like. That's not that different to like the past. We never knew how the future might look like, but because of the high volatility in just the last 2 years, I would say, we also expect higher volatility in the upcoming 1 or 2 or 3 years. And because of that, when we look at new investments, it means we are not certain if this company, this startup, might be able to raise in the next 1 or 2 years again. And that means if we are not providing them with enough liquidity in this investment round, and if they can't grow into profitability or make that shift at one point to go into profitability because they have to, because the capital markets completely dried out, then that is an additional risk that a lot of the investors are not willing to take right now. And that's probably another argument why we are more focused on profitability right now, I would say. And then maybe one last aspect that I have to add from the VC side or investor side. We at Monkfish, we always invest out of our exit proceeds because we are an evergreen fund. But also even like traditional VCs, they depend on the capital calls to the LPs, and the LPs as well are not very motivated right now to receive those capital calls because they haven't seen any exit proceeds lately because of the low valuations. So this kind of like is a self-fulfilling prophecy basically, because low valuations, no exits, no new investments. No new investments means lower valuations. So you could like turn it into a spiral there. But I think that makes it very, very challenging right now, and we will see what the future will hold. But I'm like by design, by my job, more on the positive side, like being very optimistic about the future. So it will get better at one point. So that's a very generic hypothesis that with which I will definitely not fail.
Yeah, Kim, if I may, just
yes,
on the profitability on the corporate side, I believe, this correction from a corporate perspective, I think we see that also as a positive on the profitability side for several reasons. One, because also we have invested in companies, and it's true that sometimes, making money where everybody is willing to lose money is complex. So we also see that now everybody having the focus on profitability, being corporate VC backed up, is something, because somehow it's aligned a little bit, the incentive, we believe it's a better environment for us to compete. And we believe it's a critical element. It's really a critical element in order for us to really ensure that we also consider, the startups. So we see that as a necessary correction, especially on some verticals. Okay, I'm going to take D2C that potentially we'll discuss later. We really believe that this is opening somehow a resetting of the market, which will lead, I would say, to certainly a much better framework when it comes to scaling up D2C.
So this growth at all costs formula is changing, and I think that's really important for our startups to bear in mind. The metrics have changed, and we're going to talk about that a lot more during this hour. And I'm interested by what you've said, Ole, as well, about the ability of startups to be able to get follow-on funding. Now, I think this is something that people don't think very much about. It's like, I need to raise this money, I need it now, I need to spend it, I need to do X. And they forget about, okay, what next, the next cycle of raising, and, how you're going to do that, when you're going to do that, etc. So thanks for that. And I also love the fact that you've been telling us.
To add,
yeah.
Sorry to interrupt. Maybe actually to add on that, this really it also you've probably heard the phrase of choose your investors wisely, something like that, right? Because exactly of those follow-on rounds, what we also see now, why new startups are not getting funded is because all the VCs are very much focused on first saving the portfolio companies they already invested in. So we see much more internal rounds, obviously. So that is kind of choosing the investors you want to have on your cap table. Are they even able to do follow-up rounds, and what kind of signal do they have? Because when we look at a new startup in our deal flow, obviously we look what kind of investors have already invested in the past. So it's so crucial to get this right, because it can really make it difficult down the line if you are not with the right investors, and if they can't support you in the follow-on rounds, especially in those crisis times like this, it can be can bring an end to your startup, actually.
Yeah, I love that. I think that's something that people don't think very much about. We've also heard in Linz, grab all the money you can. You cannot be too choosy when you are, about to go belly up. So there are a lot of decisions that startups have to make while in this difficult period. So no, those are good tips. So let's talk a little bit about the pet care vertical. I think in spite of all we have said, it's still a growth category, like Fabian had said. They're still quite a favorite because it's pretty recession-proof. And I have to say that pet startups have raised this year. I'm so pleased that at least 3 Unleashed startups have raised money. I see that Julian is online. Animoscope has raised some money this year. Anyfer Bio, another one of our startups, raised recently 11 million euros. Kibis and some other of our startups have raised. I'm really pleased about that. Smalls in the US has raised about 19 million lately. Omni had a Cedars oversubscription. Scrumbles raised £6 million. So the news is not all that bad. Pinnacle Pet Group, of course, pet insurance is all hot, like hotcakes now. They have done quite a lot of M&As and so on. And so we come back to the question. If you're a good startup, you will raise. And there's still money around. Cam told us there's money around. People are looking for ways to spend their money. So tell the audience, what is a good pet startup? Cam, would you like to start on what you think is a good pet startup to help us understand what investors are looking for?
I think, yes, absolutely. I think that when you stand back and you look at not even just in the pet sector, but what is a good startup and what are investors looking for in businesses? And I'd identify this as a differentiated product that meets a specific problem set that you can clearly identify and you're solving 4, you've got a good customer base that's solid to grow off. You have an omni-channel distribution, and that's becoming more important in these markets, is having that diversity of getting to revenue, strong unit economics, and the ability to scale your business and demonstrate that you can scale your business. I think those encompass where companies go. So you're growing strong revenue and then having a path to profitability, but quite a clear path to profitability if you're not there already, are things that investors are looking at across the board. And they've become much more focused on it here. In the advantage you have in the pet care sector is these fundamentals are more regularly seen across the companies, and you're able to deliver those profitabilities and those revenue growths to your investor base. I think there's the changes around how does your financial model feed through in sort of B2B or B2C models, and thinking carefully of how you're positioning yourself. But I think those are the elements that are quite key.
Good. And Ole, what's a good pet startup for you guys? Or a good startup, particularly pet?
Yeah, I think as Cam said, like not that much has changed. I think there are like still those components or criteria that we're looking at, like big problem with large markets, having a strong team. It probably also, and I can pick up the question of Dan from the chat. Definitely, it depends on the stage where a startup is because what Dan probably mentions is that in the early stages the profitability is hardly reached ever, but we look at different kind of profitabilities there. I think you can look at strong unit economics if you're early stage, for example, and a business model that is not that capital intensive as others, because the cost of capital just increased, so this is less attractive now. But to come back to what is a good pet tech startup, one aspect that when I see pet tech pitch decks or deal flow that often sets me off is actually that they kind of like aim for being the super app or the super service provider kind of thing, like we're starting with this, but this is actually not our profitable business in the end, because it only gives us access to all the pet owners in the end, and then we will do like insurances and vets and food and whatever you want to add to that, and it's all in kind of like one business model. And what we like to see is startups that really focus on one specific problem in the market, because there are definitely problems that are large enough for themselves to be solved, and you can only like be successful in the end. That is at least our hypothesis, if you really focus on them and become the specialist or the expert for this specific problem. And once you've solved that, then there might be chance to also go into other areas. But as an example, I mean, we've talked about Tractive. I'm not sure, I think they're now in the market for 8 or 10 years. They have always focused on the GPS trackers. They only provided the GPS trackers for dogs for a very long time, and then added the smaller tracker for cats. And they haven't done like the trackers for I don't know, luggages or whatever you could use those GPS trackers for. They have focused on that, and they haven't added insurances until this year, basically. They haven't done many side projects, which they could have started earlier, but they focused on that, and that really made them the expert and created the best product in this specific area of pet tech, I would say.
be the best in what you do, right? And I've always remember having this conversation with Fabian saying, and he says, it's so difficult to get one thing right. I don't understand how people can do, 4 or 5 things right. So yeah, totally agree with you. Focus, focus, focus. And that's what we tell our startups as well. And Fabian, what's a good pet startup for a corporate?
Well, for corporate, I think, what has mentioned that we mentioned before, I think is, these are timeless fundamentals, the strong funding teams, the ability to balance, the short-term needs with the long-term vision, be in a position to mobilize the resource that you need, regardless of the context, this notion of adaptability. So you see, I would say those teams. For us, a very strong USP and IP is very important with a very well-defined revenue model. It's important. I see, as Ole was saying, too many that coming to me where, okay, at some point, okay, the startup want to start selling dry food, wet food as the way somehow, to increase the opportunity versus really focusing on what they were initially built for. For us as a corporate, obviously, we're looking usually for leaders in their own market. When we look at the investment we've done recently, being Tails in direct to consumer, Wami's on the digital side, Lily's Kitchen on the ultra natural nutrition part, they were leader in their own market. And it's very important for us because somehow we know that we have a funding team, okay, which has been growing. We know as well that we have a business which is already at a size that we can take on and then scale further. Besides that, the most important element, because what's happening whenever we invest in startup is that those startups become of the Purina family. So the most important element is the alignment on values. How aligned are we with the funding team, with the funders, is a very important element because we're going to be married for a period of years. We're going to grow together. So it's very important that we do that properly. So as part of the assessment, the fit when it comes to the funders and the funding team is very important to us. Because ultimately, we have to deliver the next stage and strategic chapter of the company together.
Yeah, and what I've heard, really, I think, again, I refer back to our Pet Tech meetup in Linz. They talked very much about distinctive positioning, how distinctive you are, how differentiated you are then to your competitors. They talked about branding. They talked also about being cash flow positive. Right? Obviously, I think to Dan's question in the chat, should we distinguish between different stages of startups? Obviously, a pre-seed is not going to be so cash flow positive as perhaps a later startup. They talked about, our investors, they talked about the right gross margin when you start. If you start low, it's really difficult to get high. And that means that, getting to that profitable path will be very difficult. So I think you guys talked about the credibility of the teams as well. But one of the things that I picked up was knowing the business, really knowing the business you are in. Because I think that many times we speak to startups and they know their technology very well. They know, what they're doing very well. But when it comes to the business in the pet industry or in that pet vertical, they perhaps could be improved, right? They're a little bit weak. I don't know if you guys have any thoughts about, earlier stage startups and later stage startups. Is it different? That definition of being a good early stage startup. What's a good early stage startup? Anybody? Ole? I think you you may have some ideas
I guess
there.
it has
since
to be
you've got the Business Angel Network, and maybe that's where we can talk about
that. And our history is that we have invested very early on. I think it's this. I think there is even like academic literature about it, but let's face it, practice looks a little bit different to that. It's this ability to do multiple aspects at the same time, kind of like what is called paralyzing tasks. And if you have that together with a very strong team, it means you're getting out of the gates like right away. And you have to be fast in the beginning, and you have to show progress. because that is basically, if you're not fast in the beginning, you will not accelerate later on. That's very unlikely. And so we want to see this passion, this drive, this like, we do it with you or without you, you know, like we give you kind of the opportunity to join us as an investor, but if you're saying no, or you say like, I will like keep you on hold or something, we just go to the next one and do it without us. That's one aspect, and then it's easier to show some traction, show some product market fit. Obviously, things that are very generic and not very specific to pet tech, anyways. Having product market fit, like having your first customers that are paying, or having very good data on who is your target audience or group, and how do you approach them? What is your first channel, how you reach them? And you don't have to like figure out all the channels. Often it's just this one channel that makes like all your sales, all your marketing for the first 5 or 10 years. That might be like working for you. So it's just like you have to show how you start, and you have to show them the vision and a reasonable plan to expand and grow into a reasonable size. Because let's be honest, because you are so early, there's still so much risk attached to it, and a VC investment case is very different to a later stage PE investment case, or if you would invest at the public market. So meaning we as investors, if we invest that early, we need to see the potential that it grows into. It's often misused, but this kind of unicorn status, or that it can be really, really big, because it has to be an outlier in our portfolio. So that, again, I'm very numbers driven. The numbers have to work for us as investors, and it works only if every investment we're doing has the potential to be that outlier. And that is kind of the story that you have to tell those investors if they are driven those motives. Obviously, there are also some business angels that have different motivations to invest into startups. But if you're talking to, I call them professional business angels, or VC investors, institutional and VC investors, then you definitely have to give them a story of how we become the next leader in one of the market segments that we're tackling.
Yeah. So is it a little bit more the soft factors that are important for early startups rather than those hard numbers, because they don't have them? Or a lot of early startups have got business plans that are incredible, right? 1 million first year, 20 million second year, 80 million third year, and you're wondering, where did that come from? So yeah, I suppose the numbers when it comes to an early stage startup is going to be a little bit less, I suppose. The reason why you are investing in them is your trust and your belief that they can deliver. But I don't know whether you guys have any opinion on that, Cam or Fabian.
I think it also goes to the uniqueness of your product, or the differentiated product that you have, that at the early stage, you're bringing something that meets a problem that's not already being served by, a semi-okay product in the market, that you're truly disrupting a space, or you're replacing something that is not fit for purpose in today's world, and then truly understanding that space. So as the entrepreneur, as the management team, you're able to show investors and potential customers that this is a space that you can truly own, and we can see the pathway to how the business can grow from what you've produced and what you've captured today.
A good, unique product that works and people are willing to pay for. That's interesting. Yes.
At a price point where in the future you will be making profit. It's easy to say, let's be super competitive and go cheap, but that is you get caught into that as you grow.
And Fabian, how do you, what is your mind thinking about when you're looking at an early stage startup and they come to you hoping for some collaboration or investment?
I think building on what Cam was saying, I think very important that they really understand the space. I see too many early stage, in fact, we do not really understand what is pet care and come back to us with a misled element when it comes to what is the market. So this understanding is critical, consumer-centric, really understand exactly with your persona, understand what pain point you're going to solve. Same thing we see too many or several times we've seen, that in fact there was not really a pain point, okay, which then is leading to poor metrics. And then a recurring business model, okay, understand what's going to be the business model, I think is a critical element. So for us, and the focus, okay, same thing, the focus at the start, understand that you're in a stage where you need to acquire your first customer, you need to validate your go-to-market strategy. As Ole said, one channel being clear, you have a product, a product which is still, a prototype, you understand your pricing, all of that, I would say, are signs that would give us confidence that I would say the startup is on the right track.
Yeah, I see a question in the chat, and guys, if you want to ask a question, please type it in the chat box. We'll get to it. Kieran has said that the CAGR, optimistic, estimates the CAGR at 14% for the pet industry. Personally, I don't really care about these numbers. I know it's double digit. I know it's high growing. So if you're throwing these numbers at investors, it's probably not so important than really to talk about your product and how you're going to make a difference to pet owners. But I can safely say it's double digit. So I don't know if anybody disagrees, or how do you take numbers like that? Do you actually pay attention to them?
Well, I think what is important is that pet ownership population is increasing.
That's for sure.
It's a category where, if you look, okay, here in the UK, 90% of the people are giving commercial product when it comes to food. When it comes to Eastern Europe, it's not the case. Okay, so the increase of calorific coverage is going to be fantastic. In addition to that, we see more people getting into the category. And I think this is an important element. This is an important element which tells us that the category is going to continue to grow. And the other one I mentioned at the start is the fact that Gen Z and millennials are getting into the category, and their expectation when it comes to how the category needs to serve them is very different to the to the previous category, to the previous generation. And this open up, I would say, to new opportunities when it comes to setting up startup and new business models.
Exactly. There are lots of unmet needs out there, but there are also a lot of solutions out there looking for a need, which is really the tail wagging the dog instead of the dog wagging the tail. So we need to worry about that. So let's talk about what startups should be expecting if they're raising money. I guess a lot of our startups here are planning to raise funds this year. We've talked about valuation. In Linz, I think one of our investors said in 2021, valuations were about 22 times revenue. In 2022, it was 6 times revenue. I think it was Johan who mentioned that. Yeah, maybe we start with valuation. What is the situation right now? What can people expect in terms of if they can raise funds? What do they expect in terms of valuation? Cam, you're giving us a little grin. You must have some experience there, particularly with your advising. You're the perfect person. You are the advisor.
It is the €1 million question, isn't it? What valuation can you get things done? I'd say broader in the market, there's definitely private equity, growth capital, venture capital focused in on the broader pet care industry. We've even seen it in public markets where Dechra has got an approach from EQT at quite a sizable premium to their market cap. I think it's something like 40, in the high 40% premium, and it's a 23 times EBITDA multiple. And it really shows you what the market is prepared to pay for businesses within this industry, and that there's a huge amount of capital following it. Now, that has to be contained in the discussion we had earlier around what makes a good startup, because higher multiples will be paid for businesses that meet all of the things that we've discussed already around the profile of the businesses. And I think more generally, we're seeing a flight to quality of assets. So if you are meeting all the various criteria we discussed about being a good startup, you will get attention from the right investors that will be willing to pay up for you.
Okay. And Ori, what has happened in terms of metrics when you're looking to invest this year in startups? I know we talked about valuation. You talked about certain things as well. Are there more? What's happened to valuations and maybe other metrics as well?
Yeah, they are definitely lower. That's already for sure. We see much more instruments like liquidation preferences that play a major role to still structure certain rounds to keep up maybe some variations that the startups still need to grow into. So liquidation preference means basically the last investors get the money out first. So this kind of saves their investment because even though you would invest at a 2 million at a 10 million valuation and the startup would be sold for 4 million, you would still get those 2 million out, and the other 2 million would be distributed among the existing shareholders before that round if there are not even more liquidation preferences that need to be taken into consideration. So we see a lot of this, a lot of structured rounds, I would say. What Kem mentioned, I would say that's more for later stages, right? Mm-hmm. Like if you already have some EBITDA, if you manage to get into profitability and you have those PE style deals, maybe even strategic investors that are taking over. So in early stages, we see much smaller rounds. I think that is also very much linked to the valuation because if you don't get that high valuation that you would have raised for 25 million valuation in 2021, then it wouldn't make any difference for you to maybe like give up or like make 4 million or 5 million into this round. But if you're only raising a 10 million valuation, you can't take 5 million in that round because you would dilute by 50% if it's post money. So those lower valuation also have an direct impact, I would say, on the sizes of the round sizes. Because of the lower variations, usually we see smaller rounds, and that means again those startups not even have to try to get to profitability and show longer run rates that we expect as investors, because a year ago we would have been fine with somewhere like 9 to 12 months of runway after the investment round. Now we want to see maybe like at least 18 months, maybe even 24 months. I've heard of some investors, and you need to have this long runway with less capital that you're able to raise. So it's kind of like the worst of both worlds to come together. So yeah, it's definitely challenging right now. And maybe to add, which doesn't really link to valuations, but what we also see in the funding rounds, they take much longer. I think Kim, you already mentioned it. It's not 4 weeks. It's also definitely no longer you get a phone call on Friday. Hey, we're closing on Monday. We need your answer on Sunday. We also had these times, but now it's more, I would say, at least 4 months. I could also even say you'd sometimes need like 6 to 9 months to close a round if you're even able to close one.
Yeah, that's an alert to pet startups out there. Start early, make sure that your runway is long, and yeah, don't do it last minute, because we've seen quite a number of that. Fabian, what about you? I mean, I've heard from 5 Seasons that in the past, if you had plant-based in your deck and D2C, you raised 10 times more LTM than others. And of course, you know, post-COVID, now we are out of our houses, we're shopping again. So what are you guys thinking about when, you know, when startups are trying to raise from a corporate?
Yeah, maybe the first thing for us is that, as mentioned, you know, we've done 4 investments over the last 5 years. And the first mission we have to ensure is that, you know, we finance the growth of those ones. And you know, it's a critical element. I mentioned to you, usually, you know, we've made investment in leading in their own market and that we are scaling internationally. And this is really the first mission that we have. You know, usually we acquire companies which are on the path to profitability. So getting them to scale up profitability is a critical element. Also managing the pre-earnout, post-earnout in order to ensure, you know, that there is continuity and that we find a model for them to thrive into our organization. So, and I would say that for us, this is the first mission that we have. So, you know, we're always looking outside, but, you know, really ensuring that we do the right thing with the investment we're doing. It's very important because ultimately, you know, all the startup community which is there, it's a community. Okay, so we really want to ensure that, you know, people understand the way, you know, startups are thriving when they are in our organization. The second element for us is that we have an investment thesis which is very clear. So for us, we only look at, you know, startups that will play a role in our portfolio. Very clearly, you know, for example, as you said, Kim, direct to consumer is one that we're looking at very closely. So we've seen, and I think it was mentioned by Ole, you know, a quite fast correction. Okay, when it comes to 2 things, you know, I've seen some, you know, some pitch coming to us 6 months ago, very high negative profitability and you know, gross margin that was clearly not giving indication of potentially to scale up. And just 6 months after, seeing, you know, that being totally revised. So we need to understand how believable it is, you know, and what is the route to get there. But we see that there is an understanding from the founders on this, and we've seen, you know, big correction on the valuation. You know, significant one. But for us, you know, what is important is that we really need to ensure that we pick the one, okay, that we are in a position to scale up together. Because for us, it's all about scale up when they are part of our organization.
Good. So really interesting views from different sorts of investors. So that's very different. So guys, when you're looking and talking to people, just understand what kind of investor they are. Fabrizio has a question here. What is the best strategy for increasing the chances of successfully assessing funds? Should we start generating revenues first, or define customer base, get personas, value proposition, etc.? What's your take on it, Ole? So if a startup comes to you, what do you look at first? Do you want them to have some customers already, or do you want them to have a big a business foundation that is the reason for you to believe?
It depends.
Yeah, good answer.
Yeah, for sure. I think on the one extreme, you have those founders that already have a very strong network among business angels and investors, and maybe they are serial entrepreneurs. They will not even wait for any steps to happen before they getting like some funds to have a team to be much faster in these early days. And I think that's still possible. I mean, it's all about reputation, and serial founders still get money, and so. But if you don't have this network that is supporting you, and you haven't founded successfully before, that means I think then it's a question of where can you. I think that's a personal view, so I'm not sure. Like, you should definitely also ask other people. But my personal view would be like, I would look at it and see where can I make the most progress with the least resources that I have right now. Because once I can show this already as kind of traction, or show as successes, this gives you kind of like a starting point to show investors that you have kind of started and that you're progressing. Yeah, the golden standard is probably like try to get your product shipped, right? Getting your first customer, showing that there's a willingness to pay. I think that is probably like the golden standard, what you should always try to reach.
Yeah, that would be what I think as well. But Cam, what do you think for an early startup who is just starting off?
I think that's right. It does depend on what stage you are. So if you're right at the start, all I just mentioned, the network and the surrounding of the entrepreneur is quite important, because you are in a belief position. We've got to believe that you can drive this business. We've got to believe that you can get product market fit. As you move later on, it's having that product market fit, having the ability to distribute your product and get paid for it by customers. And then further from there, it's then being able to scale and repeat those customers, get multiple customers from different areas and different channels. And so it does depend on the stage of the business, it's very much understand where you sit in this in the journey of the companies, and making sure that you're matching the investor base with where you are. So you're networking with the right stage investors.
Correct. The right stage investors is really important. Talk to the right target. George?
Maybe one addition.
Yes, Ole?
Yeah, because I'm talking to a lot of early stage startup, and I like actually those that are approaching you and you give them feedback. They are too early for you, for example, and then some of them really figure it out to send maybe monthly updates to all the interested business angels that they have talked to previously. You don't want to be pushy in those newsletters. You just want to be like, stay in the loop, show that you're progressing, show your successes. I think that really shows you can show reliability and your motivation behind it, and you are progressing, and you're giving the investors a good feeling of when you send those updates every month, then like reporting, I can expect you to make those reportings, and that I can trust you. And it's trust building, I think, and trust is especially if you haven't raised yet and you have to raise the first round, it's a lot about trust.
Yeah,
and I would say, Kim, participating in program like Unleashed can also be a contributor, because it gives you, if you don't have the network, it gives you the network. It gives you also the access to the market, working with experts, but also the access to investors. So I really believe that it's a worthwhile investment, and we've seen from what you've done that this can bring genuine value somehow to the startup.
Thank you. I can't agree more. So yeah, use Unleashed as a networking platform. Join our events, be active in our community. You'll find that networking is so important for startup founders. So coming to George, George is a spin-off, I believe, and it's a really valid question, right? Startups have very little money, and they need to use their money in the best possible way. So should he be using his money to protect IP? It is expensive, filing patents and doing all that stuff, or just use that money to acquire customers? I guess it's kind of I suppose it's a dilemma for George. On one hand, you want to make sure that you protect your IP. How important is IP when you invest in them? Ole, you're an early stage investor, or your Business Angels Network could be an early stage investor. What's your take on it?
Yeah, we don't care. We don't care about IP at this early stage. I mean, we are not doing deep tech. I think that's maybe different. If your USP is the technology and the physical whatever in disruption you're doing there, obviously you need IP protection. But if you are some consumer-facing product, whatever, I don't care about IP. Maybe it's a little bit different at later stages where you have really professional investors. Cam, I think you might have a different point look at it.
I think it's a similar thing. If you're in deep tech or biotech and the IP is critical to your product success, then that's where you invest your time. But rather it's in early stages in consumer D2C businesses. It's about building your product and your customer base. I'd say there's one thing around, you are acquiring customers and growing, but we have to be careful around just spending on marketing and having a high CAC as you're growing, but actually having a product that appeals to a broader network of customers.
And Fabian, does a corporate worry at all, or do you care at all about IP?
Well, I would tend to agree, with Ole and Cam when it comes to digital services. I think ultimately, IP is not the critical element. When you come into deep tech, yes, it can be. When you come into some element of food tech, obviously, us as a nutrition company, it can be, but it very much depends what it is. I would agree that a D2C traditional food business, somehow, I'm not sure that there is a very strong IP behind it. What is behind it is more the founding team, the understanding of the persona and somehow proposing something which is outstanding from an execution perspective. So can you really IP that? I'm not sure. When it comes to, alternative proteins, potentially there are more IP here that needs to be discussed. So, but I would
there's so many ways. There's so many ways to circumvent IP, particularly if it's formulations. So yeah, and here in Europe, method of use is not so protectable. So really, it depends on where you are and what technology you're looking at. Felix has a question on sort of runway. Look, if you're a pre-seed, I think we talked about it. Ole, you said between 18 to 24 months. Anybody has a different opinion when it comes to a pre-seed? Cam, or?
I would say pre-seed is a little bit different.
Yeah.
To jump in. So the earlier you are, the less runway is acceptable. Pre-seed, depending whether you are just raising, let's say, like a 200K pre-seed round, no one expects you to have a runway of 18 months
18
with
months.
that. But maybe you get like to 9 months with that, so that you can start and generate proof of concept, and then raising your seed round later that year, or like after 9 months. So that would be kind of my expectation, that from pre-seed to seed, you should definitely have 9 months, and then after pre-seed, you probably have somewhere like around 15 months, maybe. Just it can always change anyways, so it's just a ballpark that you should try to consider when you have your financial planning. How much can you hire? How much can you spend on marketing to not run out of money too early?
So we have 1 minute left. So I would like to ask your advice to give to our startups if they're raising in 2023. Just give us your advice. Fabian, can we start with you? If I'm a startup, I'm raising money in 2023, what is the most valuable advice you can give me?
Be prepared, know your numbers. I would say are going to be, for me, the critical element in order to ensure that you're successful in getting more times, being with us or with the VCs.
Fantastic. Good advice. Cam?
I'd say be very clear on your use of proceeds, where you're going to spend that over the runway to attract the right investors.
And Ole?
If you want to raise and you already have a product, go out today, talk first to your existing investors and try to find new investors, but do it today because it will take time.
So Anish has already said, keep calm and carry on. It's going to come. Be resilient. And thank you so much for being with us this hour. I thoroughly enjoyed it. I hope you did. We will be putting the recording out on our website soon. You'll hear about it on the Unleashed Community Slack group. Thanks, guys. Thanks very much for joining us during this lunchtime. Have a great lunch, I hope, if you have not had lunch yet. Thank you.
Thank you. Bye-bye.
Thank you.
Bye. Thank you.
Bye.
Thank you very much. Bye-bye.
Bye.
See you.
Thanks.
Bye-bye. Thank you.